If you're looking to buy a cash flow positive property in 2026 by scrolling on listings and looking for high yield, you're about to buy one of two things: an oversupplied investor ghetto or a regional town where vacancy quietly eats your returns. Cash flow positive in 2026 isn't dead, but the way you get it has changed. You can't just find it, you need to manufacture it. And the cleanest way to do that without sacrificing on equity growth is this simple strategy. You have to buy in a location where the fundamentals are strong and convert that land into income generating assets. For those who don't know who I am, my name is Nick, I'm from Handle Properties, and our buyers agency buys $10 million worth of property every single month, and we help our investors build and scale their portfolios. Today's lesson isn't about a get-rich-quick scheme. It's a repeatable method that works because it uses demand-driven locations and manufactured yield. So let's break down exactly how you buy cash flow positive in 2026. First, let's get one thing straight. Cash flow positive is not the goal, it's the tool. Because a cash flow positive property in a dead market that doesn't grow in equity is still a bad investment. You can earn an extra $80 a week, but you can lose $80,000 in lost opportunity cost if that property does not grow over 5 years. So the strategy in 2026 is not find high yield, it's find growth fundamentals first, then manufacture cash flow on top. And this is how portfolios can scale long term. Step one is to choose the base location. Before we look at the property, we must filter for the right location. Because if the market is weak, manufacturing yield will not save you. For this strategy, we apply a tighter set of filters. First, we want stock on market to be less than 2%. We want that scarcity. Low stock means competition and resilience. The next filter is inventory levels below 3 months. This confirms that demand is absorbing the supply. Low inventory markets don't need to discount to clear stock. And days on market need to be below 60 days and improving now versus 12 months ago. This is liquidity. If it takes 100 days or more to sell, your exit is going to be slow and painful and full of discounts. Under 60 days means the market is moving, and that matters when refinancing and getting better valuations. The next filter is rental yield on houses has to be more than 4%. Even before that manufactured yield through a granny flat is done, the asset base must be rentable and supportable, and a 4% yield reduces those holding costs and improves your serviceability. The next filter is vacancy rates below 2%, and this can be the deal breaker. Getting and manufacturing yield through a granny flat relies on stable tenants and fast leasing. Under 2% means tenants compete, rents move, and both dwellings get absorbed quickly. So we're not buying regional because it's cheap, we're buying suburbs with scarcity, liquidity, rental pressure, and tight vacancy. Now we need to select the right asset. Once the suburb is right, the property selection is simple. We need to target an older, smaller house on a much larger block, ideally 600 square meters or more. Now you might be asking why older and smaller. It's because you're not paying for that shiny renovation. You're paying for full land utility. This strategy works when the block is practical, clean, and there is clean placement for a secondary dwelling, and also really good access and a layout that doesn't turn the build into a headache. Now we manufacture the cash flow. Now comes the part that flips the deal into cash flow positive. You need to build a secondary dwelling such as a granny flat. And if you do it properly, the numbers change dramatically. A typical investor spec granny flat around the country could cost between $200,000 and $250,000. And in many cases, from start to finish, it can be completed within 10 to 12 weeks. This is why this is going to work well in 2026. You're not waiting 5 years to the market to maybe lift your yield. You're manufacturing a second income stream within a defined budget and time frame. The base house might yield 4% or more, but when you combine it with a granny flat and secondary dwelling, the combined rent on the total project can hit 6.5% and sometimes even more than 7%. And the point is not just the higher yield. The yield allows you to bring your holding costs down and your serviceability improves, but the portfolio becomes easier to scale as you're still going to get that equity growth. Now, where is this going to work in reality? People hear this strategy and assume they can just do it anywhere. But no, You need to execute this strategy across Greater Melbourne, Greater Sydney, and Greater Brisbane, but be mindful that not all locations should be treated equally. Some markets naturally favor granny flats. There's strong renter depth, high family formation, tight vacancy, and tenants who are willing to live next to that secondary dwelling. But there are plenty of markets in these regions that just do not qualify, and you do not want to invest and do this strategy in a location where suddenly there are no renters lining up for a granny flat, nor the front home, which is so close to the granny flat. Because then your manufactured cash flow project turns into longer leasing time and of course discounting rents, and a second dwelling that doesn't actually improve the deal. So before we build, we need to sanity check demand and make sure that vacancy is already tight. Rentals have been growing and tenant profiles support dual occupancy living. So that's why suburb filters matter so much. They reduce the chance of building the right product in the wrong location. So in 2026, you don't just buy a cash flow positive property, you need to manufacture it. You need to buy it in a suburb with scarcity and rental pressure, with an older home on 600 square meters or more with that granny flat potential, and then manufacture the yield by undertaking the project. That's how you get to a 6.5 or 7% combined rental yield without sacrificing on equity growth. Now, if you want to follow up, let us know and we'll break down the locations, block layouts, and the red flags. And if you want help executing this with the right feasibility checks, reach out to us at Handle Properties.